If you're collecting Social Security or planning to retire soon, listen up. 2026 brings massive changes that could put more money in your pocket or take it away if you're not prepared. Social Security just announced a 2.8% cost of living adjustment affecting 75 million Americans. But that's just the beginning. There are hidden tax traps, earning limits most people don't know about, and one change that could cost high earners thousands extra. Welcome to Finance Flash, where we break down complex money topics in plain English. I'm going to walk you through every single change coming in 2026, what it means for your specific situation, and most importantly, how to plan around it. Let's dive in. What's changing first? The news everyone wants to hear. Social Security benefits are increasing by 2.8% in 2026. Here's what that actually translates to in real dollars. For retired workers, the average monthly benefit will rise from $2,015 to $2,071. In January 2026, that's about $56 more per month. For couples where both spouses receive benefits, you're looking at an increase from $3,120 to $3,208 per month. Now, if you're on disability or SSI, you'll see similar percentage increases. Disabled workers will go from an average of $1,586 to $1,630 monthly. When you'll get it. Here's the important part about timing. SSI recipients actually get their first increased payment on December 31st, 2025. That's because January 1st is a holiday, so they're paying early. This means SSI recipients get the 2026 increase before 2026 even starts. For regular Social Security recipients, your payment date depends on your birth date. Those born between the 1st and 10th get paid January 14th, born between the 11th and 20th, January 21st. And if you're born between the 21st and 31st, you'll receive it January 28th, the reality check. Now here's what nobody's talking about. A 2.8% increase sounds great on paper, but healthcare costs for retirees typically rise faster than general inflation, which means your purchasing power might not actually improve. Think about it. Your Social Security goes up by $56, but Medicare Part B premiums are increasing to $229 in 2026, up from $185 in 2025. That's a $44 monthly increase right there. So your net gain? Only about $12 a month after Medicare eats into it. This is the hidden erosion most retirees don't realize is happening. The cost of living adjustment isn't designed to get you ahead, it's designed to keep you from falling further behind. And even then, it often falls short. What high earners need to know, now let's talk about a change that affects high-income workers. The maximum amount of earnings subject to Social Security payroll tax is jumping to $184,500 in 2026, up from $176,100 in 2025. Here's what this means in practice. On every dollar you earn up to that cap, you pay 6.2% in Social Security tax. Your employer matches that with another 6.2%, bringing the total to 12.4%. If you earn at or above $184,500, you'll pay $11,439 in Social Security tax in 2026. Your employer pays the same amount. That's an increase of $521 each compared to 2025. If you're self-employed, you're paying both sides the full 12.4%, though you can deduct half of it on your taxes. Who this actually affects? Only about 6% of workers earn more than the taxable maximum, so most people won't be impacted by this change. But if you're a high earner, you're going to notice more money coming out of your paycheck in 2026. Here's the silver lining, though. Higher contributions now mean higher Social Security benefits when you retire. Your benefit calculation is based on your highest 35 years of earnings. So, if you're consistently earning at or near this wage-based limit year after year, you're building toward a much larger monthly check in retirement. In fact, let me show you the maximum possible benefits. If you maxed out earnings for 35 years straight, you could receive around $2,900 monthly if you claim at 62, over $4,000 at full retirement age, or $5,100 to $5,200 if you wait until age 70. Very few people hit these maximums, but it gives you perspective on what's possible if you're a consistent high earner. The limit most people don't know about this is where a lot of people get tripped up. If you claim Social Security before reaching full retirement age and you're still working, there's an earnings limit you need to watch. In 2026, if you're under full retirement age, you can earn up to $24,480 per year. For every $2 you earn above that limit, Social Security withholds $1 in benefits. Let's say you're 64 collecting Social Security, and you pick up a part-time job earning $30,000 a year. That's $5,520 over the limit. Social Security will withhold $2,760 of your benefits, $5,520 divided by 2. Now, in the year you reach full retirement age, the limit jumps to $65,160, and the penalty is less harsh. They only withhold $1 for every $3 you earn over the limit. When the limit disappears, here's the critical detail. Once you hit full retirement age, which is 67 for most people today, the earnings limit completely disappears. You can earn $1 million a year if you want, and Social Security won't withhold a single penny. Also, if benefits are withheld because you exceeded the limit, those benefits aren't lost forever. Social Security recalculates your benefit once you reach full retirement age to account for the months they withheld, and you'll get a permanently higher benefit going forward. Strategic planning opportunity. This creates a powerful planning opportunity. If you're approaching retirement, you could claim Social Security early, work part-time earning just under the limit, and preserve your investment portfolio during those early retirement years. For example, earning $24,000 from part-time work plus your Social Security gives you cash flow without touching your 401k or IRA. This could save you tens of thousands in the long run by letting your investments continue growing. This is what I call a phased retirement. It's not all or nothing. You gradually transition out of work while maximizing your income sources and minimizing taxes. Understanding the 40 credits to qualify for Social Security, you need 40 credits, essentially 10 years of work. In 2026, you earn 1 credit for every $1,890 in earnings. And you can earn a maximum of 4 credits per year. This trips people up all the time. You could earn all 4 credits in 1 month if you make $7,560 in January and then not work the rest of the year. You'd still get your 4 credits. The confusion between eligibility and benefits here's where people make a critical mistake. Eligibility is not the same as calculating your benefits. Yes, you only need 10 years of work to qualify for Social Security. But your benefit amount is based on your highest 35 years of earnings. So, if you only work 10 years, Social Security plugs in zeros for the other 25 years when calculating your benefit, which drastically lowers your monthly check. The lesson. You technically qualify with 10 years of work, but you'll receive significantly more if you work at least 35 years with solid earnings. The tax nobody talks about this is huge, and most people have no idea it's coming for them. Up to 85% of your Social Security benefits can become taxable income. Here's how it works. Social Security uses something called provisional income to determine if your benefits are taxable. That includes half of your Social Security benefit, plus all your other taxable income, plus tax-free interest. The thresholds haven't changed since the 1980s. If your provisional income as a single filer exceeds $25,000, up to 50% of your benefits become taxable. Above $34,000, up to 85% can be taxed. For married couples filing jointly, it's $32,000 and $44,000. These numbers were set 40 years ago and have never been adjusted for inflation. Back in 1984, the average Social Security benefit was $460 a month. Today, it's over $2,000, so naturally, way more retirees are crossing these outdated thresholds simply because of wage growth and inflation, not because they're wealthy. The new deduction for 2026. Here's some good news. There's a temporary federal tax deduction for people 65 and older that runs through 2028. It's $6,000 per person. or $12,000 for married couples if both spouses are 65 or older, but there are income phase-outs. Single filers get the full deduction up to $75,000 income, then it phases out completely by $175,000. For married couples, it's $150,000 to $250,000. This deduction isn't tied to Social Security specifically, it's based on your age and income. You get it whether or not you're claiming Social Security? But it can indirectly reduce the taxes you pay on your benefits, which is incredibly valuable. If you're doing Roth conversions, withdrawing from a traditional IRA, or taking required minimum distributions, this deduction could save you thousands in taxes over the next few years. Real-world impact. Let's bring this all together, because these changes create a web of consequences that interact with each other. If you're a current retiree, your 2.8% COLA is helpful, but might not keep pace with your actual expenses, especially healthcare. Factor in rising Medicare premiums, and you might be treading water at best. If you're a high earner still working, you're paying more into the system in 2026, but that translates to higher future benefits. It's not necessarily a bad thing. Think of it as forced retirement savings. If you're claiming early and still working, watch those earnings limits like a hawk. Going over by even a small amount can trigger benefit withholding that creates serious cash flow problems. And for everyone, understand the tax implications. More Social Security benefits are becoming taxable every year simply because those thresholds from the 1980s have never been updated. This isn't by accident. It's a stealth tax increase on retirees. Strategic moves for 2026? Here's what you should do right now. 1. Review your estimated Social Security benefits. Log into your account at ssa.gov and see what you're projected to receive at different claiming ages. 2. If you're still working and approaching retirement, model out different scenarios. When should you claim? Should you work part-time? How do the earnings limits affect you? 3. Plan for taxes. If a significant portion of your Social Security will be taxable, consider strategies like Roth conversions in lower income years or managing your other income sources to stay below those provisional income thresholds. 4. Don't forget about that temporary $6,000 deduction if you're 65 or older. Work with a tax professional to maximize it over the next few years before it expires in 2028. And 5. Remember that these are just routine annual adjustments. They don't address the bigger issue. Social Security's trust fund is projected to be depleted in the early 2030s. Congress will eventually have to make structural reforms. So stay informed, stay flexible, and don't build your entire retirement plan around Social Security staying exactly as it is today. So there you have it, every major Social Security change coming in 2026 and exactly how it affects your money. The 2.8% COLA sounds good until you factor in rising Medicare costs. The higher taxable wage base hits high earners harder but builds bigger future benefits. The earnings limits create traps for early claimers who keep working. And the tax implications are getting worse every year because Congress refuses to update 40-year-old thresholds. Bottom line, these changes matter. They affect your monthly income, your tax bill, and your long-term financial security. If you got value from this breakdown, hit that like button and subscribe to Finance Flash for more no-nonsense money content. Drop a comment and let me know, are you claiming Social Security in 2026 or are you waiting? I'll see you in the next one. Stay informed, stay ahead.